analysis on property prices and kind of where things are going. I'm not even getting into the unit side of things, just as an FYI. And normally I hadn't had time to help prepare these slides today, so thanks for Nicholas and Ian, but I normally remove the unit side of things. Unit pricing in general is very, just as an FYI for a lot of people out there, very manipulated, the unit pricing, particularly because the newer build units, or the last few years, they are specced out a lot differently than some of the older units. They tend to be building the units bigger, but the land size is pretty similar or smaller. But it can be a little bit misleading on some of the data. So I'd like to just look at the houses. So if we look at the property prices here, got Sydney market in the rolling 12 months, they're still up about 5%. So 5% still technically outperforming inflation, which is great. And the rolling change, so they've had a bit of a spike in the last month or so. If we go down to Melbourne, so Melbourne's been just treading water, particularly that high end of the market. Your more expensive suburbs in Melbourne have been feeling the pinch more than your more affordable ones, but they've had another positive upswing. And you've then got Brisbane. I would say Brisbane, it's had a 0.2. It's cooling down a lot. I recall about a year ago, this was around a 20% number. And Perth is starting to cool a little bit, but I mean, you're not going to be complaining if you've got, the best part of 16% capital growth over 12 months. But again, it's actually had its first month of a pullback. So interesting. I think Perth will start to run out of steam through this year. I still think your Brisbane, Perth and Adelaide markets will be your strongest performers for the next 12 months. It'll be interesting to see what happens after that as investors start to see value in other markets. And a lot of podcasts out there are starting to pump up Melbourne even more so as well. Canberra, no one cares. We'll skip over Canberra. No, we'll just be being serious there. They've gone back -1%. You got Darwin had a bit of an upswing as well, and then you've got Hobart is ticking along just neutral last month. But Hobart will be an interesting one. It looks like it's bottomed out down there in Hobart, because it was pulling back for a period of time. Hobart, for those who aren't aware, over the last 2 decades has been basically the number one kind of growing city across the country. So had a really big spike, pulled back a little bit after COVID, and now it's kind of bottomed out and starting to, it's a little bit of an upswing potentially. It's a bit of a watch and see for us in the office. Nationally though, national average, so 6.9% growth over the last 12 months, 0.3% over the last month, and the capital city average. So capital cities seem to have got a bit of a shot in the arm, more than the rest of the country in the last 12 months. No surprise, because your more expensive markets, which typically will be Melbourne and Sydney, they rely heavily on serviceability. And that's, those markets rely on that. And the more expensive the property is, the more money you likely need to borrow. You're going to require serviceability to be able to get into those markets. And if we look on the rental side of the market, it looks like the rental market is starting to normalize. I wouldn't say cool off, I'd say normalize. Normally rents are going to fluctuate somewhere between kind of, I'd say, high 2s to high 5s, around about 4 or 5% is kind of the average. Markets are starting to kind of normalize a little bit. Adelaide and Perth still 6s and 7s. But those markets starting, because the last 2 years, pretty much across the country, the national average has been nearly double-digit growth for 2 consecutive years. So probably good news for renters or rent investors in there as well, that the rents are starting to stabilize a little bit. And that's to be expected almost, because though landlords love to get painted as the greedy person in the conversation, landlords in general are just looking to cover their cost base. As long as their properties are growing in value, they're not really concerned too much about the cash flow, because cash flow in general is pretty poor in the residential space. And if interest rate cuts, or interest rates are stable or they're cutting their costs, they'd rather keep the same tenant in place. You kick the tenant out for what, an extra 10, 20 bucks, might be vacant for a couple of weeks. You don't know what tenant you've got. So in general, landlords prefer to keep the same tenant in place, and that cost base is starting to stabilize, which is good to see.